I've been in this investment game for over 7 decades now, and I've seen people make the same mistake over and over again. They chase get-rich-quick schemes, they follow hot tips, they panic when markets drop, and they celebrate when markets soar. But here's what I've learned. The real wealth, the kind that lasts, the kind that lets you sleep soundly at night, comes from one simple concept that most people completely overlook. It's called dividend investing. And today I'm going to show you exactly how to generate $2,900 every single month from it. Not by getting lucky, not by timing the market, but by following the same principles that turned me from a kid delivering newspapers in Omaha into one of the wealthiest people on earth. Let me start by telling you something that might surprise you. When I was young, I delivered the Washington Post to people's doorsteps. Years later, I bought a massive stake in that very same company. Why? Because they paid dividends. They shared their profits with their owners. And that, my friends, is the beautiful simplicity of dividend investing. You become a part owner of a business, and that business sends you checks month after month, year after year, whether you're sleeping, eating breakfast, or playing bridge with my friend Bill Gates. Now, I want to address something right off the bat. A lot of folks think you need millions of dollars to live off dividends. That's simply not true. Yes, you need capital. Yes, you need patience. But the path to generating $2,900 per month, or about $35,000 per year, is more achievable than most people realize. And I'm going to show you 3 specific strategies to get there. But before we dive into the strategies, let me explain why dividends are so powerful. You see, when you buy a stock, you're buying a piece of a business. Now, that business has profits. What should they do with those profits? They have 2 main choices. They can reinvest every penny back into growing the business, or they can share some of those profits with the owners, which is you, the shareholder. When they choose to share, that's a dividend. Think about it this way. If you owned a local restaurant and it made $100,000 in profit this year, you'd want some of that money in your pocket, wouldn't you? You might reinvest $50,000 to buy new equipment or expand, but you'd probably take the other $50,000 home. That's exactly what dividend-paying companies do. They're successful, profitable businesses that share their success with you. Now, here's where it gets really interesting. The power of dividend investing isn't just about the income you receive today. It's about what happens when you reinvest those dividends to buy more shares. Those new shares pay dividends. Those dividends buy even more shares. It's a snowball effect. I call it the 8th wonder of the world, and it's how fortunes are built. Let me give you a real example from my own experience. Back in the late 1980s, I started buying Coca-Cola stock. I paid about $1.3 billion for my stake.
Today, Berkshire Hathaway receives over $700 million in dividends from Coca-Cola every single year. That's more than half of our original investment coming back to us annually.
And we still own all the stock. That's the magic of quality dividend-paying companies. But I'm getting ahead of myself. Let's talk about what you really want to know. How to generate $2,900 per month. That's $35,000 per year. For some people, that's enough to cover all their basic expenses. For others, it's a nice supplement to Social Security or a pension. Or either way, it's real money that can dramatically improve your quality of life. The amount you need to invest depends entirely on something called dividend yield. This is simply the annual dividend divided by the stock price. If a stock costs $100 and pays $5 in dividends each year, that's a 5% yield. It's basic math, but understanding this concept is crucial. Here's the thing most people don't realize. Not all dividend yields are created equal. A company paying a 10% yield might sound better than one paying 3%, but that high yield could be a warning sign. Maybe the company is in trouble and the stock price has crashed. Maybe they're paying out more than they can afford. I've always preferred companies with moderate, sustainable yields that grow over time rather than companies with sky-high yields that might disappear tomorrow. Now, let me walk you through 3 specific strategies to reach that $2,900 per month goal. These aren't theoretical ideas. These are real practical approaches that people are using right now to generate income from their investments. Strategy number 1, covered call ETFs. Now, This is a newer approach that I find quite interesting, even though it's not exactly how I built my fortune. Covered call exchange-traded funds combine stock ownership with option strategies to generate higher income. Let me explain how they work in plain English. Imagine you own 100 shares of a great company. Those shares pay dividends, maybe 2 or 3% per year. Now, you can also sell someone the right to buy your shares at a higher price sometime in the future. When you sell that right, you receive a premium, which is extra income on top of your dividends. That's essentially what covered call ETFs do on a large scale. These funds invest in a portfolio of stocks and simultaneously sell call options on those stocks. The options premiums get paid out to shareholders as dividends, resulting in much higher yields than traditional dividend stocks. Some of these ETFs are yielding 11 to 12% annually. Let's look at some specific examples. XYLD, which focuses on the S&P 500, has been yielding around 11.83%. OILK, which invests in energy infrastructure, yields about 11.82%. EWZ, which focuses on Brazilian stocks, yields approximately 11.81%. Now here's the math. If you want to generate $35,000 per year and you're earning an average yield of 11.8%, you'd need to invest approximately $297,000. Let's round that to $300,000 for simplicity. That's significantly less than what you'd need with traditional dividend stocks. But, and this is important, there are trade-offs. Covered call strategies can limit your upside potential. If the stocks in the ETF soar in value, you might miss some of those gains because of the call options. Also, these high yields aren't guaranteed to continue forever. Market conditions change. Volatility affects option premiums. You need to understand what you're getting into. My general philosophy has always been to invest in things I understand completely. If covered call ETFs make sense to you, if you understand how options work and the risks involved, they can be a tool in your arsenal. But don't invest in something just because the yield looks attractive. Understand the mechanics, understand the risks. Strategy number 2, high yield real estate investment trusts. Now, this is something I'm much more familiar with. Real estate has created enormous wealth over time, and REITs allow you to invest in real estate without the headaches of being a landlord. REITs are companies that own and operate income-producing real estate. It could be apartment buildings, shopping centers, office buildings, hotels, warehouses, or specialized properties like cell phone towers or data centers. By law, REITs must pay out 90% of their taxable income as dividends. That legal requirement makes them excellent dividend vehicles. The beauty of REITs is that you get exposure to real estate, which I've always considered a valuable part of a diversified portfolio, without having to fix toilets at 2 in the morning or deal with problem tenants. The REIT management teams handle all of that. You just collect your dividends. Now, there are some REITs out there offering very high yields. Two Harbors Investment Corporation yields around 20.3%. Brandywine Realty Trust yields about 19.9%. Orchid Island Capital yields approximately 19.4%. These are mortgage REITs which invest in mortgage-backed securities rather than physical properties. They can offer higher yields, but they also come with higher risks. Here's what you need to understand about high-yield REITs. That high yield exists for a reason. Maybe the market is worried about their properties. Maybe there are concerns about their debt levels. Maybe interest rates are creating challenges for their business model. I'm not saying don't invest in them. I'm saying you need to do your homework. Historically, REITs as an asset class have returned about 10.8% annually over the past 20 years. That's a solid return that includes both dividends and appreciation. If you're targeting $35,000 per year in dividend income and you expect a 10.8% yield, you'd need to invest approximately $324,000. But here's where it gets interesting. You don't have to go for the highest yielding REITs. You could build a diversified portfolio of quality REITs with more moderate yields, say 6 to 8%, and still achieve your goals with a slightly larger investment. The benefit is you'd likely have more stable dividends and better sleep at night. Some of the REITs I find interesting are those with strong competitive positions. Realty Income, which calls itself the monthly dividend company, owns thousands of properties leased to stable tenants on long-term contracts. Public storage dominates the self-storage industry. These companies might have lower yields, around 4 to 5%, but they've been increasing their dividends for decades. If you built a portfolio of quality REITs yielding an average of 6%, you'd need about $583,000 to generate $35,000 annually. That's more capital required, but you'd own pieces of real tangible assets with management teams that have proven track records.
One huge advantage of many REITs is that they pay dividends monthly instead of quarterly. If you're trying to generate monthly income to cover living expenses, this is incredibly valuable.
Imagine getting dividend checks every single month like clockwork. That's the reality with many REITs. Strategy number 3, dividend aristocrats. Now we're talking about my kind of investing. Dividend aristocrats are companies in the S&P 500 index that have increased their dividends for at least 25 consecutive years. These aren't fly-by-night operations. These are established, high-quality businesses with tremendous competitive advantages. Think about what it takes to increase your dividend for 25 straight years. You have to navigate multiple recessions. You have to adapt to changing technologies and consumer preferences. You have to maintain profitability through bull markets and bear markets alike. Only the strongest, most resilient companies can achieve this. Some examples of dividend aristocrats include companies like 3M, a diversified industrial company that's been around for over a century. Walgreens, Boots Alliance, one of the largest pharmacy chains. Leggett & Platt, which makes components for bedding, furniture, and automobiles. These companies have been increasing dividends not just for 25 years, but in some cases for 50 or even 60 years. The average yield on dividend aristocrats tends to be lower than covered call ETFs or high-yield REITs, usually around 3 to 4%, though some pay more. Let's say you find a portfolio of dividend aristocrats yielding an average of 7%. To generate $35,000 per year, you'd need to invest $500,000. Now, that sounds like a lot of money, and it is. But let me explain why this might actually be the best approach despite requiring more capital. First, these dividends are incredibly reliable. Companies don't achieve aristocrat status by accident. They're managed conservatively. They have strong balance sheets. They generate consistent cash flow. The likelihood of your dividend getting cut is extremely low. Second, these dividends grow over time. That 3% yield you're earning today might become 5% or 7% on your original investment 10 years from now because the company keeps raising the dividend. This is crucial for maintaining your purchasing power as inflation erodes the value of money over time. Third, you're not just getting dividends, you're also getting the potential for capital appreciation. Many dividend aristocrats have outperformed the broader market over long periods because they're simply excellent businesses. So while you're collecting your dividends, the value of your shares is likely growing too. Let me give you some real numbers. Johnson & Johnson, a company I've admired for years, has increased its dividend for 61 consecutive years. Someone who bought shares back in the early 1980s is now earning a yield on their original investment that's well over 50% per year. Think about that. If you invested $10,000 back then and just held it, you'd be receiving over $5,000 every year in dividends alone, and your shares would be worth multiples of what you paid. Procter & Gamble has increased dividends for 67 consecutive years. Coca-Cola, which I mentioned earlier, has increased dividends for 61 consecutive years. These aren't just good companies. They're exceptional companies with products people use every day, recession or no recession. Here's my approach to building a dividend aristocrat portfolio. I look for companies with strong competitive advantages, what I call economic moats. I want businesses that will be around and thriving decades from now. I want companies with products people need, not just want. I want management teams that are disciplined and shareholder friendly. I also diversify across different industries. I might own a healthcare company like Johnson & Johnson, a consumer goods company like Procter & Gamble, a food and beverage company like Coca-Cola, an industrial company like 3M, and a financial company like a strong bank or insurance company. This way, if one sector struggles, the others can pick up the slack. Now, let me address the elephant in the room. Whether you choose covered call ETFs needing $300,000 REITs needing $324,000, or dividend aristocrats needing $500,000, that's still a substantial amount of money. How do you actually accumulate that kind of capital? The answer is the same way I built my fortune. $1 at a time, with patience and discipline. You start by saving aggressively. You live below your means. You invest every spare dollar, and you let compound interest work its magic. Let's say you're starting from scratch at age 35, and you want to generate that $2,900 per month by age 60. That's 25 years. If you invest $1,000 per month and earn an average return of 8% annually, you'll have approximately $950,000 at age 60. That's more than enough to generate $35,000 per year using any of the three strategies I've outlined. If you can invest $1,500 per month, you'd have over $1.4 million after 25 years. At $2,000 per month, you'd have nearly $1.9 million. The key is starting now and staying consistent. Time is your greatest ally in building wealth. Here's something else I want to emphasize. Dividend investing isn't about getting rich overnight. It's about building a reliable income stream that lasts for decades. It's about creating financial security and independence. It's about sleeping soundly at night, knowing that quality businesses are working for you 24 hours a day, 7 days a week, generating profits and sharing them with you. I've seen so many people chase hot stocks, cryptocurrencies, day trading schemes, and other get-rich-quick nonsense. Some get lucky, most lose money, but the people who build real, lasting wealth do it through patient, disciplined investing in quality assets. Dividend stocks are the epitome of that approach. Let me tell you about dividend reinvestment, because this is where the magic really happens. Most brokers offer automatic dividend reinvestment plans, or DRIPs. Instead of receiving your dividends as cash, they automatically use those dividends to buy more shares of the stock. This costs you nothing, and it supercharges your compound growth. Let's say you invest $100,000 in a stock yielding 4%, so you're getting $4,000 in annual dividends. If you reinvest those dividends to buy more shares, and the stock price grows at 6% annually, in 20 years you won't just have more shares, you'll have dramatically more wealth. Without dividend reinvestment, your $100,000 would grow to about $320,000 from the stock price appreciation alone, and you'd have collected $80,000 in dividends along the way. That's $400,000 total, which is nice. But with dividend reinvestment, you'd have approximately $540,000, all in stock. That's $140,000 more, a 35% difference just from reinvesting those dividends. And now your annual dividend on that larger position would be over $21,000 instead of the original $4,000. That's the power of compounding. Now, let me address some common concerns people have about dividend investing. The first is, what if the company cuts its dividend? This is a valid concern, and it does happen.
During the 2008 financial crisis, many companies cut or eliminated their dividends. Even some banks that had paid dividends for decades were forced to cut them. This is why diversification is so critical. If you own 20 different dividend stocks spread across different industries, and one cuts its dividend, it only affects 5% of your portfolio. The other 95% keeps paying. This is also why I prefer companies with long track records of dividend growth and strong balance sheets. They're more likely to maintain their dividends even in tough times. The second concern is taxes. Qualified dividends are taxed at capital gains rates, which for most people is 15%, and for some it's 0 if your income is low enough. This is actually quite tax efficient compared to ordinary income. And if you hold your dividend stocks in retirement accounts like a traditional IRA or Roth IRA, the taxes are deferred or eliminated entirely. The third concern is inflation. If you're earning $35,000 in dividends today, will that be enough 20 years from now when everything costs more? This is where dividend growth becomes crucial. Companies that consistently raise their dividends help you keep pace with or exceed inflation. A company increasing its dividend by 7% annually will double your income in about 10 years, which is much faster than inflation typically runs. Let me share some principles I've followed throughout my career that apply directly to dividend investing. First, invest in businesses you understand.
If you don't know what a company does or how it makes money, don't invest in it. There are thousands of stocks to choose from. Stick with businesses whose operations make sense to you. Second, look for companies with competitive advantages. I want businesses with strong brands, loyal customers, high switching costs, or network effects. These moats protect the company from competition and allow them to maintain pricing power and profitability over time. Third, examine the balance sheet. Companies with too much debt are vulnerable during downturns. I prefer companies with manageable debt levels and strong cash flows. This gives them the flexibility to maintain dividends even when times are tough. Fourth, evaluate management quality. I want to invest alongside managers who think like owners, who allocate capital wisely, and who prioritize long-term value creation over short-term stock price manipulation. Look at management's track record. Have they been good stewards of shareholder capital? Fifth, pay a reasonable price. Even a wonderful business is a bad investment if you pay too much. I look at metrics like price-to-earnings ratios, price-to-book ratios, and dividend yields to assess whether a stock is reasonably priced. Sometimes it's worth waiting for a better entry point rather than overpaying in your excitement to own a great company. Sixth, think long-term. I've said many times that my favorite holding period is forever. When you find truly excellent businesses at fair prices, you should plan to hold them for years or even decades. The transaction costs of constantly buying and selling add up, and you miss out on the magic of compounding. Now, let me walk you through what a practical dividend portfolio might actually look like for someone targeting that $35,000 per year in income. I'm going to create a hypothetical portfolio of $500,000 using a mix of all three strategies we discussed. First, I'd put $150,000 into a diversified group of dividend aristocrats. Maybe I'd buy Johnson & Johnson, yielding about 3%. Procter & Gamble, yielding about 2.5%. Coca-Cola, yielding about 3%. 3M, yielding about 6%. And Chevron, yielding about 3.5%. This portfolio would yield roughly 3.6% on average, generating about $5,400 annually. These are rock-solid companies that will very likely keep paying and growing their dividends for decades. Second, I'd put $150,000 into quality REITs with more moderate yields. Maybe Realty Income, yielding about 5%. Digital Realty Trust, which owns data centers, yielding about 3.5%. Prologis, which owns logistics warehouses, yielding about 3%. Essex Property Trust, which owns apartments, yielding about 3.5%. And Vicky Properties, which owns casino properties, yielding about 5.5%. This portfolio would yield about 4.1% on average, generating about $6,150 annually. Third, I'd put $100,000 into a covered call ETF like XYLD to boost the overall yield. At 11.8%, this would generate about $11,800 annually. Fourth, I'd put $100,000 into a high-yield REIT like Two Harbors Investment Corporation. At 20.3% yield, this would generate about $20,300 annually. Add it all up, $5,400 plus $6,150 plus $11,800 plus $20,300 equals $47,650 per year, or about $3,970 per month. Now, that's more than our target of $2,900 per month, which gives us a margin of safety. Some of those yields might decline, some dividends might get cut, but even if our total income dropped by 20%, we'd still be generating over $38,000 per year above our target. This portfolio is diversified across different strategies, different sectors, and different risk levels. The dividend aristocrats provide stability and growth. The quality REITs provide real asset exposure and monthly income. The covered call ETF boosts yield, and the high yield REIT adds extra income, though with extra risk. Is this the perfect portfolio? No, because there's no such thing. Everyone's situation is different. Your risk tolerance, tax situation, time horizon, and income needs are unique to you. But this gives you a framework for thinking about how to construct a dividend portfolio that meets your goals. Let me share one more crucial point. The journey to dividend independence is as important as the destination. Every dollar you save and invest is a dollar that's going to work for you. Every dividend you receive is validation that you're on the right path. Every year that passes brings you closer to financial freedom. I've been investing since I was 11 years old. I bought my first stock, City Service Preferred, for $38 a share. I've made mistakes. I've learned lessons, but the fundamental principles haven't changed. Buy quality assets at fair prices, hold them for the long term, and let compound interest work its magic. Dividend investing is one of the most powerful wealth-building tools available to regular people. You don't need insider information. You don't need to trade constantly. You don't need to watch CNBC all day. You just need to identify quality businesses, buy their shares, and collect your dividends. The path to generating $2,900 per month in dividends is clear. Save aggressively, invest consistently, choose quality over excitement, think long term, reinvest your dividends until you need the income, and have patience. The stock market is a device for transferring money from the impatient to the patient. Whether you choose covered call ETFs, high-yield REITs, dividend aristocrats, or a combination of all three, the key is getting started. Too many people spend years analyzing, planning, and preparing, but never actually invest. They're waiting for the perfect moment, which never comes. The best time to start investing was 20 years ago. The second best time is today. I'm 80 plus years old now, and I'm still investing. I'm still learning. I'm still finding opportunities. The stock market has been incredibly good to me, not because I'm smarter than everyone else, but because I followed simple principles consistently over a very long time. You can do the same thing. You can build a portfolio that generates meaningful income. You can achieve financial independence. You can sleep soundly knowing that quality businesses are paying you dividends while you're watching television, playing with your grandkids, or traveling the world. The choice is yours. You can keep making excuses, or you can start building wealth. You can chase the latest hot stock, or you can invest in proven businesses with decades of dividend growth. You can panic when markets decline, or you can buy more shares at cheaper prices and collect even more dividends. I've shown you 3 concrete strategies to reach $2,900 per month in dividend income. I've explained the principles behind successful dividend investing. I've shared insights from over 70 years of investing experience. Now it's up to you to take action. Start small if you need to. Buy your first dividend stock this week. Set up automatic investments. Reinvest your dividends. Stay focused on quality. Think long term. And watch your dividend income grow year after year until it reaches that $2,900 per month target and beyond. The beautiful thing about dividend investing is that once you build your portfolio, it works for you automatically. The companies manage themselves. The dividends get deposited into your account. Your wealth compounds. All you have to do is stay patient and disciplined. This isn't complicated. It's not rocket science. It's simple arithmetic and common sense. But simple doesn't mean easy. It requires discipline to save when you'd rather spend. It requires patience to hold when everyone else is selling. It requires courage to invest when markets are scary. But if you can master those qualities, if you can follow the principles I've outlined today, you can achieve financial independence through dividend investing. You can generate that $2,900 per month. You can build a portfolio that provides for you and your family for generations. That's the power of dividend investing. That's the path to financial freedom. And that's what I've spent my life doing. Now it's your turn.